Okay, so now we have another paper about changes in interest rates, but from a very different perspective. And Shohini Kundu from Anderson School of Management will talk about diverging banking sector. And you have 25 minutes for the presentation.
The opportunity to present this paper today. It's a pleasure to be at this conference. This is joint work with my colleagues at UCLA, Tyler, Muir, and Jinyuan Zhang. The motivation for this paper comes from the observation of a fairly recent phenomenon in deposit markets. Today, several of the largest banks, including Bank of America, JP Morgan Chase, Wells Fargo, pay virtually zero interest on savings accounts, while several other banks, like Marcus by Goldman, Capital One, and Citibank, pay over 400 basis points on the same savings accounts. This bifurcation in deposit markets is not limited to a handful of banks. In fact, if we look more broadly, there's substantial heterogeneity in deposit rates across financial institutions in the United States today. The spread in deposit rates in the banking sector has almost reached 4.3%. And this divergence in deposit rates applies more broadly than savings accounts. We observe a similar phenomenon for other deposit products. So in this paper, we're going to use the divergence in deposit rates as a starting point to understand how banks' business models have fundamentally changed over the past 2 decades, and the implications this has for the transmission of monetary policy and the banking sector's ability to originate long-term loans and safe loans. So we begin by showing that this divergence in deposit rates is a new phenomenon. Back before the great financial crisis of 2008, when the Fed funds rate was similar to what it is today, the difference between the 75th percentile of deposit rates and the 25th percentile of deposit rates was 75 basis points. Today, it's well over 350 basis points. So before the great financial crisis, deposit rates followed a unimodal distribution with similar mean and median values and low standard deviations. So in this figure, we're plotting the distribution of 2 types of deposit rates. DEP rate is essentially interest expense, which measures the average deposit rate that the bank offers on all its deposit products. The CD rate refers to the CD rate on a 12-month certificate of deposit with a minimum account size of $10,000. Now, what we observe is that when the federal funds rate was 5.25%, the average DEP rate was 3.01%, and the median was 2.99%. So they were quite closely clustered together. Similarly, the average CD rate was 3.97%, and the median was 3.94%. So deposit rates before the financial crisis were narrowly distributed. This has markedly shifted over the last 2 rate hiking cycles. Today, we see that there are divergent mean and median values. Today, deposit rates follow a bimodal distribution with 2 distinct peaks and an economically large spread between. And this divergence in deposit rates is quantitatively large. So since the 3rd quarter of 2006, the standard deviation of deposit rates has almost quadrupled from 0.53 to 2.02. So in this paper, we show that this divergence extends beyond deposit rates. In this project, we document the evolution of banks' business models, both on the assets and liability side over the last 2 decades. Effectively, there are 2 types of banks in the banking sector today. There are high-rate banks and there are low-rate banks. High-rate banks set deposit rates that are in line with market interest rates, while low-rate banks all set similar rates, which are virtually insensitive to movements in market interest rates. What explains the emergence of these 2 types of banks? We argue that technological innovation in the advent of e-banking services plays a critical role. So high-rate banks operate primarily online with far fewer branches. In fact, since 2009, the number of branches operated by high-rate banks has declined by 75% more than low-rate banks. Now, these high-rate banks set deposit rates that vary with market interest rates. So in order to minimize exposure to interest rate risk, high-rate banks match the duration of their assets with the duration of their liabilities. And so we find that the average maturity of assets held by high rate banks is half of what it is for low rate banks. Now, you may think, well, these high rate banks are paying out more in liabilities and they're holding shorter maturity assets. So, all else being equal, their net interest margins should be lower. Actually, what we find is that high rate banks report a higher net interest margin. And the reason for that is they compensate the lack of maturity risk by taking on more credit risk. The credit spread associated with high rate banks is more than 300 basis points higher than that of low rate banks. And the charge-off rate, which represents the portion that the bank expects won't be repaid, is also 3 times higher than that of low rate banks. Now, an important part of our findings is not just that high rate banks behave differently than they used to, but it's also that low rate banks behave differently than they used to. It used to be the case that if the Fed raised rates by 100 basis points, low rate banks passed on 68 basis points to their depositors. Today, that figure has fallen to 15 basis points. So when the Fed raises rates, what happens is that rate-sensitive depositors leave low-rate banks, leaving sleepy depositors who really value in-person services at these low-rate banks. Now, as a result, these low-rate banks have a captive depositor base whom they can charge higher prices to in the form of lower rates. Consequently, these low-rate banks have increased the maturity of their assets in line with the idea that their liabilities act more like fixed-rate liabilities. So when the Fed raises rates, deposits flow from the low-rate banks to the high-rate banks, which has tremendous implications for the banking sector's capacity to extend longer maturity loans and originate safer loans. And so what we find by doing a back of the envelope calculation is that a 10 percentage point shift from low rate banks to high rate banks would result in the banking sector holding 5% shorter maturity assets and 8% higher credit risk. Now, our findings are also important because they help reconcile a puzzle, which is why a credit crunch hasn't materialized despite a series of aggressive Fed rate hikes. Because low-rate banks specialize in long-term securities, whereas high-rate banks specialize in lending, when the Fed raises rates, deposits disproportionately flow out of the low-rate banks. Since these low-rate banks are specialized in securities, they cut back on their holdings of securities. Lending is not affected as much since personal loans and business loans are issued by high-rate banks. So let me jump right into how we classify high-rate and low-rate banks. We begin by focusing on the systematically important banks. So these are the top 25 banks based on assets. We focus on these banks because the top 25 banks are subject to similar regulation, so they're comparable by nature. But we find that our findings are robust even if we extend the analysis to all banks. We rank these banks based on the average standardized ranking of both their deposit rate and the CD rate series. Based on the asymmetric distribution shown earlier, the top tercile of banks are high-rate banks, and the remaining banks are low-rate banks. So this classification scheme generates persistence in the classification. We find that 60% of banks are either high-rate banks or low-rate banks for the entirety of the sample. An additional 35% are classified as either high rate or low rate for 90% of the sample. And in these instances, we assign the bank its major bank type. So who are these high rate and low rate banks? Here's a list of some of these high rate and low rate banks. One thing I'd like to point out is that both SVB and First Republic Bank were low rate banks, which helps explain why when the Fed raised rates, there were large outflows of deposits from these banks. Note, the findings that I'll present going forward are not being driven by the failure of those particular banks. SVB and First Republic fall out of the top 25 during bank runs. Okay, so this table provides a summary of the key findings of the paper. We compare the behavior of high rate and low rate banks outside of the zero rate regime. So between 2001 to 2007 and between 2017 and to 2023 when rates were comparable. The first row confirms the divergence in deposit rates. So the difference in deposit rates between high-rate banks and low-rate banks has tripled in the recent period compared to the early 2000s when the Fed funds rate was quite similar. We show that this divergence in deposit rates is mirrored by a divergence in banks' branching strategies. High-rate banks have cut the number of branches by over 50% in the recent period we examine, while low-rate banks have expanded their physical presence and increased the number of branches. So as a result, we observe a significantly larger difference in the branching strategies of high-rate and low-rate banks. Now, this divergence also shows up on the asset side. We find that there are larger differences in the net interest margin, credit spreads, and the maturity of assets that are held by these banks. Importantly, these differences on the asset side are primarily driven by low-rate banks. So the low-rate banks report lower net interest margin, they report lower charge-off rates, and the maturity of their assets is higher than that of high-rate banks. So we delve into each of these aspects one by one. First, we present the time series of the average deposit rate over our sample period. Now, before 2009, high-rate and low-rate banks set similar deposit rates. So in response to a change in the Fed funds rate, high-rate and low-rate banks responded similarly to these changes. So we observe a narrow and consistent differential between high-rate and low-rate banks prior to 2009. However, a dramatic shift occurs in the last two rate hiking cycles, in which we observe that as the Fed raises rates, high-rate banks actively increase their rates, whereas low-rate banks remain largely stagnant. Our hypothesis is that this divergence in deposit rates is linked to a divergence in banks' branching strategies. So we begin by comparing the distribution of banks' branches to deposits ratio in the third quarter of 2007 to the second quarter of 2022. A higher branch to deposits ratio indicates a larger number of branches relative to deposit size, which can be indicative of a broader physical presence and potentially higher operating costs. Now, what we observe is that the dispersion in the branches to deposits ratio has increased over time. This widening gap in branch utilization across banks suggests that banks are increasingly divergent in their branching strategies. So we examine the number of branches directly. What we find when we plot the cumulative branch growth of low-rate and high-rate banks over time, as well as run a regression analysis, is that first, high-rate banks consistently maintain a lower number of branches than low-rate banks. And second, since 2009, high-rate banks have reduced their number of branches by 75% more than low-rate banks. Now, to address the concern that perhaps branch closures may be driven by deposit withdrawals, we also compare the ratio of branches to inflation-adjusted deposits for high-rate and low-rate banks. Now, what we observe is that, yes, both high-rate and low-rate banks have experienced a decline in the ratio of branches to deposits, but it's fallen at a significantly steeper rate for high-rate banks relative to low-rate banks. The branch deposit ratio has declined for high-rate banks by 64% more than low-rate banks since 2009. And high-rate and low-rate banks appear to cater to distinct demographics. The high-rate banks tend to locate their smaller number of branches in areas that are demographically younger. So prior to 2009, both high-rate and low-rate banks operated branches in areas that exhibited similar average population ages. After 2009, what we're seeing is that high-rate banks are increasingly concentrating their branches in areas that have an average population of about half a year younger than that of low-rate banks. Now, we've supplemented this analysis using the FDIC's survey on banking and financial institutions usage, and we find that individuals who tend to use physical branches are those who are older in age, less educated, and have lower income relative to those who use mobile banking. So, all else being equal, if high-rate and low-rate banks have identical portfolios on the asset side, the prediction is that the net interest margin should be lower for high-rate banks than low-rate banks. This is because the high rate banks are paying out more on the liability side. What we actually observe is that there's been a divergence in the net interest margin over time. And actually, high rate banks report a higher net interest margin than low rate banks. This suggests that high rate banks have tilted their portfolio towards higher yielding assets. Now, there are two ways through which banks can achieve higher income. They can either take on more credit risk, or they can invest in long-term assets to earn a term premium. So we look at each of these in turn. First, we compare the credit spread of high-rate banks to that of low-rate banks. And the way we measure the credit spread is by subtracting the term premium from the loan rate. The term premium itself is derived from the yields on maturity-matched treasury bonds. And so what we see is that before 2009, high-rate and low-rate banks reported somewhat similar credit spreads. After 2009, a divergence has opened up between high-rate and low-rate banks. And today, high-rate banks report a credit spread that is more than 300 basis points higher than that of low-rate banks. Now, as high-rate banks assume more credit risk, it suggests that the risk of borrower default is higher. This elevated risk can result in portfolio losses, which would be reflected in the charge-off rate. So the charge-off rate essentially is the portion of the loan portfolio or credit accounts that the bank deems non-collectible and removes from its books. What we find is that throughout our sample, high-rate banks report a higher charge-off rate than low-rate banks. But in the recent period, high-rate banks report a charge-off rate that is more than triple that of low-rate banks. So it suggests that these high-rate banks are earning a spread from riskier lending. How do these how do high-rate banks manage interest rate risk? Well, one hypothesis is that high-rate banks may compound their credit risk with interest rate risk by investing in longer-term assets to increase asset yields. Now, another hypothesis is that high-rate banks may be averse to investing in long-term assets because it exposes them to interest rate risk, and which can result from mismatches on their balance sheet. So we compare the maturity profiles of high-rate and low-rate banks. What we find is that at the start of our sample, low-rate banks report an average maturity of around 6 years compared to 4 years for high-rate banks. Now, while high-rate banks have maintained the maturity of their assets around 4 years, 4 to 5 years, low-rate banks have gradually increased the maturity of their assets. And today, the maturity of assets held by low-rate banks is 8 years, which is twice that of high-rate banks. So how do these banks achieve divergent credit and maturity risks? We show that high-rate banks tilt their portfolio towards personal lending and commercial and industrial lending, which carries a higher charge-off rate, but is short-term in nature. By contrast, the low-rate banks invest more in longer-term assets, such as mortgage-backed securities, agency bonds, and real estate loans, which are safer in nature, but have an average maturity that's more than 10 years. So collectively, this illustrates that banks have contrasting risk-taking behaviors. High-rate banks opt for a shorter-term portfolio because essentially they have a narrow spread that they earn on the liability side. So to preserve that spread and minimize interest rate risk, they invest in shorter-term securities. But they compensate by taking on more credit risk. In contrast, low-rate banks opt for longer-term investments that are safer in nature to hedge against fluctuations in the deposit franchise value. So what are the macro implications of a diverging banking sector? Well, we begin by examining how monetary policy transmits to high-rate and low-rate banks through the deposits and lending channels, examining both prices and quantities. Now, what we observe is that both high-rate and low-rate banks exhibited similar sensitivity or deposit betas prior to the Great Financial Crisis of 2009. Now, in the recent 2 cycles, low-rate banks have hardly changed their deposit rates. The deposit beta of low-rate banks is 0.15. In contrast, high-rate banks have reported a deposit beta of around 0.56, which is comparable to the levels observed pre-crisis. So if you have a bank that changes its rates with market interest rates and a bank that doesn't change its rates and is less sensitive to movements in market interest rates, the prediction is that when the Fed raises rates, deposits will reallocate from the low rate banks to the high rate banks. Consistent with this hypothesis, we find that when the Fed raises rates by 100 basis points, high rate banks experience an additional 2.5 percentage points growth in deposits relative to the low rate banks. Now, this reallocation of deposits has tremendous implications for lending. Because the low rate banks specialize in long-term assets such as securities, when they experience an outflow of deposits, they cut back on their holdings of mortgage-backed securities. In contrast, when the Fed raises rates, money flows from the low rate banks to the high rate banks. So the high rate banks increase their share of personal lending and business lending. This is important because this reallocation can help reconcile a recent puzzle, which is why hasn't a credit crunch materialized despite a series of aggressive rate hikes by the Fed? In 2022, banks experienced an annual deposit outflow of over 8%, which is the largest in percentage terms since 1973 when the FDIC first began collecting this data. Despite these large deposit outflows, we haven't experienced a significant credit crunch. And our findings provide a potential explanation. When the Fed raises rates, deposits disproportionately flow out of the low rate banks. The low rate banks specialize in securities. And so the low rate banks cut back on their securities holdings as a result of experiencing an outflow of deposits. The figure to the left plots the deposit growth and the Treasury agency growth, and you can see the two series track each other nearly one-to-one. In contrast, the high rate banks are less affected by Fed rate hikes. Because they're the ones that specialize in lending activity, lending is less affected. In fact, because money flows from low rate banks to high rate banks when the Fed raises rates, we actually find a negative correlation in the recent period between deposit growth and loan growth. So this redistribution of deposits has implications for the capacity of the banking sectors to do maturity transformation and the amount of risk that's there. Using our regression estimates, we do a back of the envelope calculation, and we find that a 10% shift in deposits from low rate banks to high rate banks would result in the banking sector as a whole holding assets that have 5% shorter maturity and assets with about 8% higher credit risk. Now, this is important because the credit risk is concentrated among a subset of high rate banks. And so this has implications for financial stability. Specifically, both credit risk and interest rate risk can contribute to bank runs. But the important thing to note is that credit risk and interest rate risk materialize under different economic conditions. Low rate banks are hit harder by Fed rate hikes, which likely happens in overheated markets. When this occurs, there are higher deposit outflows and larger reductions in asset valuations. And that's exactly what we saw in the 2023 banking turmoil with SVB and First Republic, which were low rate banks. Now, in contrast, credit risk spikes during economic downturns, which is often associated with the Fed cutting rates. What's important is that high rate and low rate banks exhibit differing sensitivities to changes in the credit cycle and the monetary policy in the monetary cycle. Now, what we find is that current regulation may not adequately capture these differing sensitivities within the banking sector. If we compare the capital ratios of high rate banks and low rate banks, we find that there's a lack of divergence between these bank types. That's important because the regulatory framework has implications for accurately assessing how much systemic risk there is. So what are the underlying channels? A key aspect of our analysis is the turning point, which is 2009, that may coincide with financial regulations and banking reforms. However, our analysis doesn't support this mechanism. Instead, what we find is that the advent of e-banking services explains the emergence of high rate and low rate banks. E-banking allows banks to offer services without branches. So in this figure in red, we've plotted Google search intensity of mobile banking, which you can see takes off from 2009. In the same period, 3G network coverage also began to increase in the US, which is a key infrastructure for mobile banking. So if we redo our regression analysis, replacing this binary post indicator with a continuous measure of technological adoption, we find that our results are robust. We further rationalize our findings through a theoretical model, which shows how the advent of e-banking services affects the asset liability management of high rate and low rate banks. Now, I don't have time to go through the model, but I'll just say two things about the model. The first is that the model shows a stable equilibrium emerges when you have high rate banks which operate exclusively online, and you have low rate banks which offer both branches and e-banking. The low rate banks benefit from a large deposit spread they earn on the liability side. Low rate banks have local deposit market power, which allows them to offer lower rates and steady deposit rates with a low deposit beta. The low rate banks don't take on more credit risk because essentially they want to preserve this golden goose, which is the deposit franchise value that delivers a steady stream of cash flows on the liability side. Instead, they invest long-term to match the maturity of their assets with their liabilities, which operate more like fixed-rate debt. So one question that may linger is, are these findings being driven by changes in the composition of banks among the top 25, or is this driven by within-bank changes in strategy? For example, are banks changing their business model over time? What we find is that both composition changes as well as changes in the business models of individual banks contribute to these diverging patterns. So there are both changes occurring on the extensive margin and intensive margin that explain the results. So let me conclude. This paper documents a diverging banking sector. We find that high rate banks operate fewer branches. They originate shorter term loans, but riskier loans. In contrast, the low-rate banks operate with more branches. They invest in long-term securities that are safer in nature. Now, the high-rate banks are they aren't mutual funds. They're critical to supporting lending activity in the economy. In contrast, the low-rate banks are increasingly resembling bond funds in the sense that they're investing in long-term securities. Now, our findings suggest that going forward, monetary policy may have more of a muted effect on personal lending in business lending. So I'll leave it there, and I'm looking forward to the discussion. Thank you.
Thank you very much, Shohini, for the very interesting presentation. So then we move to the discussion, which will be provided by Olivier de Jonghe from the National Bank of Belgium, ECB, and Tilburg University. And you have 10 minutes, Olivier.
Okay, so first of all, thanks for inviting me to discuss the paper. So just in a nutshell, what is the paper doing and what did we learn? So we learn a lot about the US banking structure, specifically post-global financial crisis. I at least learned a lot more. So there is an emergence of an impact. What is the emergence of what is the impact of the two distinct types of banks? So in a nutshell, there are high rate banks, or let's say high deposit beta banks and low deposit beta banks, and they have different asset structures. So basically the high rate banks will have short-term assets, mainly consumer lending, consumer credit and corporate lending. The low rate banks, or the low beta banks, are mainly focused on mortgages. One channel that has been shown to be important is basically how the transmission of monetary policy is going to be differentially transmitted by the high and low deposit beta banks, because they also have different asset structures. And what is the mechanism they try to show here is that this divergence at least is due to / coincides. So because this is a stylized fact paper, not necessarily showing causal effects, it coincides with the advent of online banking, the presence of 3G networks, and so on. So this is at the same time a difficult paper to discuss and, let's say, an easy paper to discuss. It's easy because it's gigantic. There's so many stylized facts. You show implications, you show different macro implications. So I can pick on many things. It's difficult because I cannot do the typical endogeneity police kind of discussion, because it's not about showing causality. Basically, what you also show is that, so at least you show 8 main results on different aspects of the asset side, on the number of branches and so on, the transmission of monetary policy. And then they show different, the channels, robustness of the channels, and so on. And if you look at this table, so this is, all I can see is stars. I mean, whatever you try to do, you get stars, you get significance. So I could try to focus and bring up an alternative. I think my effort would end up with an additional line in the table, bringing more stars to this. So what I would like to do is basically zoom out, and I will have two parts of zooming out in this discussion. So it's going to be a bit more high level. So one thing is what I think is currently underdeveloped in the paper. I'm not saying it should be in the paper, but it's just like my interpretation of some of the findings. It's more to link it to the theme of the conference. So it's macroprudential, financial stability, and actually going back to 2 points of, two important aspects that are linked to systemic risk. So one is going to be about diversification versus diversity. The other will be about competition and stability. So what is the first dimension I would like to discuss? So if you would take a step back and put yourself into 2009 world, so post-global financial crisis, a lot of the discussion was about what are the benefits of diversification of banks, and should we have diversification versus diversity? Meaning with this is that diversification of activities might be good from a idiosyncratic bank point of view. So it's going to reduce standalone risk, but it's going to make all banks more alike. So it's going to lead to an increase in systemic risk. And this has been shown by many people, but so Wolf Wagner has meant some theory papers in GF and GFI showing this. And then there was a discussion, so taking this from a Vox EU column by Wolf Wagner and Charles Goodhart, basically trying to show and think about what kind of regulation might force banks to internalize the externality they impose by diversifying. And they said basically banks are not going to do this by themselves. We need regulation. Their suggestion was let's impose capital requirements that are linked to the extent to which bank stock returns are correlated, co-vary with the overall market index. So if you're more diversified, if you're more alike, you should internalize this by having a higher capital requirement. And there was also arguing which margins a bank may have had or a banking system may have in terms of how to diversify and how to get to more diversity, which is basically by specializing more on the asset side, specializing more on the liability side, or also specializing in getting diversity in risk management. And actually, so what the stylized facts in this paper show is that you can tick all these boxes without any specific regulation. So this is basically puzzling to me in a sense that like one technological advancement was creating everything that was basically argued in 2009 to be impossible without imposing more regulation. So now we have diversity, we have two types of banks with potentially good implications for reducing systemic risk and increasing financial stability. So this is an argument that I feel is a bit missing in the paper, or at least linking this to diversification versus diversity. So one graph that is also far away in the appendix of the paper is basically this evolution of the market shares, the combined market shares of these 25 largest bank holding companies in the US. And what you can actually see is that it was rising tremendously, before the global, until the global financial crisis, going from 40% to above 70, or close to 70% for the 25 largest US bank holding companies, and has been stable ever after. So this contrasts a bit with what we've seen in the keynote before, that basically the market shares by the top 5 largest banks would increase even more after a financial crisis. But this could be reshuffling within the set of 25 largest banks. But at least a lot of actions seem to be going on before that, and it's large banks taking over medium-sized banks. So one thing is that you could also argue that it's not necessarily IT, but as of 2009, they wanted to reorient it and basically think about what they could do with this new combined entities. And you're ignoring a bit what is going on before 2009 in terms of this acquisition profile. So these two banking types might also emerge because some of them might have been more interest rate versus others might have been across different states. So whether you want to reduce branches a lot depends on whether you basically have been acquiring banks that were close to you or not. There has been a lot of literature, and that's why I said initially here, so among many others, I'm going to refer to only one paper. I do this on purpose for 2 reasons. So one reason is because it's co-written by a colleague, by Agnese. The other one is that because it's a nice overview of a very large and rich literature on competition and stability that touches on many important elements that might be relevant for the results that you have shown. So taking some results from the paper, pulling them together in a different format, I think this paper also speaks to the literature, or might speak to the literature on competition and stability. So first of all, one result you show is that basically that the high rate banks, or the high deposit beta banks, also have higher loan rates and higher spreads, right? One small argument here, so basically spread is going to be maturity, but not necessarily risk adjusted. So which doesn't need to mean that this is going to be more taking on more credit risk. So for that, you would need to have to compare it to both a maturity adjusted and risk adjusted, basically a corporate bond financing. Because this could very well also reflect pricing power in the corporate lending market. It doesn't have to be necessarily bearing credit risk. So I think this is something important to tease out. What else that I learned, and which I find extremely important here in the transmission of monetary policy, is that pre-2009, these two different banks existed, but the sensitivities were different. So the sensitivity of this interest rate spread, or the net interest margin, so what you get on the assets versus what you pay on the deposits, the sensitivity of this net interest margin to monetary policy was different for the high and the low deposit beta banks. So it was basically neutral for the low deposit beta banks. It was actually negative for the high, the banks that adjust their deposit rates. This has flipped completely. So in a sense, they have converged and to a positive effect. So post 2009, both types of banks you had this divergence, but both now are basically have a positive sensitivity in the net interest margin to changes in the monetary policy rate. So this implies somehow, which is good news for financial stability. So basically, if central bank rates are increased, so if they're tightened, at least both types of banks will see an increase in the net interest margin, leading to more profitability, so no potential negative interactions between monetary policy and financial stability. But it also, for me, implies that both get market power on different sides of the balance sheet. So one type of bank may get market power on the asset side, the other type of bank may get market power on the funding side by not adjusting when rates are changing. And both benefit from this by seeing a rise in the net interest margin. So, and that's why I'm referring again to this specific paper, because they tie together the literature that has shown that competition in banking may have an impact on stability, but they show the mechanisms that might be different through having competition on the deposit market, competition in the asset market. They link it together, and they also show how it may affect the transmission of monetary policy, as well as the risk taking by banks and financial stability. So I think a lot of these results that you have in the paper could be linked to all the results, or the summary of the literature in the paper by Agnès and co-authors. So I think in these two parts we're missing from the discussion. I'm not saying it should be in the paper, but it's just like a big picture overview. So the other part of my discussion and the zooming out part is basically is potentially linked. If I want to put it like a very broad picture, is going back to Modigliani Miller. So basically, why is there so much of a link between the funding side of the bank and the asset side of the bank? And what you bring here in the paper is that it's changes in online banking that forces, that allowed banks to change their deposit rate setting, and that brought about a lot of changes on their asset side. Which type of assets they focus on, which risk they're going to face on, or which risk they're going to face, either credit risk or interest rate risk. And so this basically shows that a lot of frictions must be present for why, and basically leading Modigliani Miller not to hold here. So what I want to emphasize here is that there might be a lot of, there's some other literature showing that there might be directly deposit loan synergies. And I want to argue, what I want to bring to the story here is that for me, it's not always clear whether this should be a link from banks diverge in their deposit rate behavior or the deposit side, and this should, and then the loan side or the asset side should follow, but it could basically be the other way around. So basically, banks make adjustments on what they want to do on the asset side, and then of course, it's the deposit side that would have to follow. And one of these deposit loan synergy stories is going to work in line with your results. The other one is going to work against the results that you're showing. So, and all the literature has shown basically, so this is the empirical paper, so it has shown that there might be important deposit loan synergies and how this basically allows banks to deal with liquidity risk. So we're basically back to the first paper somehow on liquidity risk. So what this paper is basically showing is that, or this idea of deposit loan synergies is that theoretically it has been shown that, first observation is that banks, of course, obviously combine transaction deposits with loan commitments. What has been shown theoretically by Kashyap, Rajan, and Stein is that there might be a diversification synergy between them, and this has been tested and shown empirically. In the sense that typically, if banks have a lot of unused loan commitments, this exposes them to more risk, but the exposure to risk will be reduced more if they're funded more with transaction deposits. And that's exactly because there might be deposit loan synergies in the sense that when in the adverse states of the world, when there might be more liquidity needs on the asset side, so more runs on the credit lines, there's also going to be either an inflow of deposits due to monetary policy tightening, or there's going to be a lack of resources to invest, and basically depositors pull out of money market funds and go back to depositors, to banks. And that's what they showed before the global financial crisis in the US banking sector. So there might be an automatic diversification benefit from combining these transaction deposits with loan commitments. So in this case, what does it mean? If banks shift to a model with more corporate lending compared to real estate lending, they're more exposed to this credit line drawdown risk, and if funding conditions, especially if funding conditions tighten. So this might be either monetary policy tightenings, or this might be a sector-specific shock. So what do these banks have to do to avoid this liquidity risk? They have to adjust the rates on their deposits to avoid deposit outflows. So that would basically refers the story that it's basically the asset side changes would lead to deposit side or funding type changes. I think by itself this coincides with the results you show, but it argues the other way around. So it's basically asset side determines the funding side and the choices you have to make on whether you want to be a low deposit beta bank or a high deposit beta bank. And then finally, another aspect where deposits and lending decisions are clearly going to be linked is the scope for cross-selling opportunities. So these cross-selling opportunities are going to be much larger for banks focusing the second type of banks. So it's the banks that focus on the real estate market. And this has also been shown in recent work, also advocating here, or putting my colleagues in the spotlight by Christophe Bastien, who is also at the ECB. They have shown that basically there might be a lot of cross-selling opportunities. So a bank is more likely going to sell a loan to an existing depositor, and they're going to basically take this horizon into account so that they're going to actually depositors are going to pay a premium on borrowing, but they will also benefit on the deposit side. And actually what they show in this cross-selling papers, cross-selling literature, is that banks are going to internalize this future cross-selling and the rents they may extract from future mortgages by actually setting lower deposit spreads to onboard and retain the depositors, which would actually be the flip side of what you would find. So basically this would mean that if you expect a lot of cross-selling, especially in banks that focus on mortgages, they would adjust their deposit rates more and they have lower spreads, which contradicts with the findings you have. Also, they have a follow-up paper where they show that this effect plays even more of a role when policy rates are going to be low. So, not saying that all of these things need to be done or addressed in the paper. It's just basically there is so many results, so many stylized facts, so many new insights, and a focus on macro implications for monetary policy that I think that either in future work, or in your discussion, there should be more of a focus on the impact here on financial stability, on the role of competition in these two markets, pricing power that banks may have on assets and liability sides, and basically also whether the functional form of banks is basically going from deposits to assets or from assets to deposits, or whether this is a joint decision triggered by something else than just the advent of online banking. Just to conclude, this is a very interesting paper, a lot of new stylized facts. So it contradicts with the long historical point of view. It's focusing on the facts in the last 10 years, but it's going to lead to a lot of many new questions and new insights and a lot of follow-up research. Thank you.
Thank you very much, Olivier. And I think we have time to collect a couple of questions from the audience. Stein?
There kind of a fixed effect here that you're trying to explain here. So the the low rate banks versus the high rate banks that stuck in 1990 and then they move forward? Or is there some endogeneity with the capital position and what they've been doing on the asset side? And the story that I have in mind is, why does Bank of America differ from Citibank? Well, Bank of America ended up being a quote-unquote lazy bank. They only bought mortgages, but then it kind of got stuck with buying that with that business model during the QE period, ended up having even more mortgages to accommodate liquidity that was plentiful during that period. And then they found them kind of in an SVB situation in which they couldn't get out of anymore in some sense, and continued doing along that line. So hidden risk or capital positions, if you account for those properly by mark-to-marketing, may show something more intrinsically what the differences are between these banks. Do you do some of that, and can you explain the story that way?
Hi, hello. Bruno Albuquerque from the IMF. I have a question. I'm sympathetic to your claim that we haven't seen a credit crunch because there might be some credit substitution between like the low rate banks and the high rate banks. So to further strengthen our argument, and we know that so far during the past tightening cycle, we have seen so far a soft landing, which didn't happen in the previous, when you go back to the previous GFC. So there might be a component there that credit demand is there because we haven't seen a recession so far. So in different words, is there a way that you can kind of compute what is the role of the credit substitution in mitigating the fall in credit that would have happened even without a recession? And are you missing something else on the, I don't know if you can do it with the data. So there is credit substitution from low rate banks to high rate banks, but what about the role of non-banks, which we know have plenty of literature, right, on the deposit channel of monetary policy. When you have an increase in interest rates, non-banks pick up the slack in providing credit. And so in a way, if you can document what is the credit supply substitution that is provided now by high rate banks. And the second comment is related to what Olivier mentioned on your claim that high rate banks might be providing more risky credit. So the fact that you don't adjust for the maturity, but also your claim seems to be that they provide non-mortgage loans. But in the US, until recently, and the GFC was the case, mortgage loans turned out to be quite risky. And these were provided by the low rate banks. So is this a good proxy of low credit risk, just the fact that they don't provide real estate loans? Thanks.
Okay, I think there was one more question over there. If you could try to keep it brief, and then I would turn back to Shohini.
Yes, thanks. So Iñaki Aldasoro from BIS. Let me just quickly follow up on Bruno's point in terms of the non-bank funding. So we know that also when rates rise, money market funds assets go up a lot, but these guys actually do not fund non-financial corporations. They fund banks. So the low beta banks are going to be banks typically that lose the deposit funding, but then compensate this with wholesale funding from money market funds in terms of repos and CDs. So at the end of the day, they also end up paying market rates on the funding that they lost. And it's not that they lose funding overall. And this is something that I missed in the presentation. I would like to get your views on. Thanks.
Okay, and thank you everyone for the questions. And I would turn back to Shohini for a response.
Let me try my best to address some of these questions. Some of the questions had 5 questions baked in them. So I'll try my best. So first, thank you to Olivier for the very insightful discussion. I think it's helpful to get another perspective on what we're working on. And I think there's a lot of food for thought for us to think more about. So let me take more time to think about some of the comments and address some of these questions. So the first question about whether this is a fixed effect result, whether this is a within bank change, or whether we can say that this might be correlated with capital requirements. We do the analysis including bank fixed effects and find that many of the results go through, suggesting that there are changes that banks are making in their business strategy. So for example, Citibank is an example of a bank that used to be a low rate bank. And recently they switched to offering more than 400 basis points. So that's one example of how banks can oftentimes change their business model, and then subsequently differences in branching strategies would also show up. The second part of that question, we don't find that there is a divergence in the capital ratios of low rate and high rate banks, suggesting that these differences are not being driven by differences in capitalization. Can this be driven by QE? Again, we looked at securities holdings of banks because obviously QE played an important role in affecting the reserves of low rate and high rate banks. And we find that the share of reserves is quite comparable between low rate and high rate banks. On the second and third questions about non-banks versus banks, one interesting insight of the paper is that the substitution that people have often talked about between banks and non-banks can appear within the banking sector in a setting where you don't have differences in regulation. So oftentimes the argument is that shadow banking has grown as a result of regulatory arbitrage because banks are constrained by regulation, which non-banks are not constrained by. In this setting, the top 25 banks face a similar set of regulation. And so the key force that's leading to these differences in the provision of credit is technology. We look at the lending rates, which can also proxy for the degree of demand to understand whether this is being driven more on the demand side or driven by the bank side. And we find that this is mostly driven by decisions that the bank is making. Now, the reason why this is important is because oftentimes the way the deposit channel works is that while the Fed raises rates, deposits decline, and that affects the decline in lending. But it's important to consider the heterogeneity within the banking sector, because even if you don't have a change in the aggregate amount of deposit flows, similar effects can occur if there's a reallocation of deposits within the banking sector. And so that's why the results matter beyond just considering, flows between the banking sector and the non-banking sector. On the last point on wholesale funding, we do compare both the wholesale rates, the rate of wholesale funding, as well as the share of wholesale funding. We find that the wholesale funding rate is higher for high rate banks than low rate banks, which might reflect that these banks have higher credit risk relative to the low rate banks. And second, on the share, we find that their utilization of wholesale funding is lower for the high rate banks compared to the low rate banks.
Okay, very much. Thank you very much, Dan, for the very interesting session.